Good morning and good afternoon, wherever you're joining us from. Thank you for joining us for today's masterclass. We are still availing our Knowledge Academy at no charge, and these are just best practice guides, quick reference resources that can help you with different areas of business during this time. How do you navigate the pandemic? Finally, for access to finance, we have launched our investor readiness program, where we shall be looking at what financing is available in the market, what you're looking for, and take you through a program to bridge any gaps that will end up making you either bank ready or investor ready, and we will finally, through this program, link you to finance. So for today's masterclass specifically, we have also partnered with Ongoza, who is also an SME accelerator and development partner. And what Ongoza does, very briefly, they are able to support early stage, high potential entrepreneurs, basically youth, according to our definition in Kenya, below 35. And they support you through consulting services, capital, community, to make sure that you are progressing towards business growth and you're able to create jobs. So Invest in Africa is an ecosystem of different players who are all geared towards supporting SMEs and creating jobs, hence why we partner with Ongoza. The objectives of today's masterclass are very simply as alluded to by the theme of funding sources and options for SMEs in East Africa. We are here today to help you understand what are the key considerations that you need to make when you're gearing towards raising finance. We also will be helping you identify SME funding for different sectors which is available in the region today. And finally, just a quick look at what are the various funding options are available to SMEs to support recovery and resilience, to enable you to build better, and thus be able to understand which would be the most suitable option for your organization. And to bring the masterclass to us today, I'm delighted to introduce our facilitator of the day. For those who have been here before, you're familiar with Frank Mwiti, who is the Eastern Africa Markets Leader for EY Africa. He's based in Nairobi, responsible for the top-line growth of the firm across advisory, transactions, assurance, and tax services. He has vast experience and expertise in strategy, in M&A, governance, and execution across private sector and public sector. Welcome, Mwiti. We are so delighted to host you today as our facilitator for the day. You're most welcome. Thank you.
Thanks, Terry. Now, the session today is meant to highlight the funding options and sources for SMEs in East Africa. Bear with me because I've been a bit more focused on Kenya, but a lot of the sources we highlight will have an East African footprint as well. And the way we are going to approach this session is to first highlight where funding sits in the scheme of things. And then number two is to also share with you the key considerations that particularly SMEs need to take into account when they are sourcing funding. And then we'll also share with you some options and pros and cons depending on which funding option you go for. And then we'll also share some indicative sources. And then after that, I'll start off with the first session, which is on strategic growth driver, funding as a strategic growth driver. And this is important because it puts context around not just where we are from a market perspective, but how you position funding in the scheme of things, even as you try and grow your business, either using your own funds or alternative funds. So the first thing is to put context, and the first context that's worth highlighting is that in all likelihood, we are going to see an up and down economic recovery going forward. Those of you that have been in these sessions before will be aware of this point, that all the data is showing that whether or not we weather this pandemic fairly quickly or in a protracted way. Either way, the economic recovery in just about everywhere in the world really will be sought. So you'll see ups and downs, ups and downs. Of course, for East Africa, there are certain key events that are going to happen in the coming years that will impact our economic goals. The case in point, for example, is the upcoming election in Kenya, for example. But the key point to take away is that you're going to have a sawtooth economic recovery, and you therefore need to, of course, build an enterprise or a business that resonates with that and is able to manage that. This point is important as well from a funding perspective, because it will enable you to see what sort of funding you want to, the funding options that are best for you, and even more importantly, how you negotiate your funding when it comes to that. And we'll touch on that as we go along. I would also want to just re-emphasize again that in the scheme of things, in terms of where we are in the economic recovery process, we are more or less finalizing the next phase, and we are getting into the beyond phase. I keep emphasizing this point in every masterclass we have, because it ensures that you have the right strategies and approaches as you build your business. So you will by now have hopefully adapted your operations to navigate a fairly topsy-turvy economic environment. You will have made arrangements to increase your resiliency, for example, reducing your costs and potentially even shutting down any units or relationships that are not productive. And now you're repositioning for growth, because the markets look like they're going to open up. And more importantly, of course, there's going to be new opportunities for you. So that it's important to emphasize that you ought to be thinking about the beyond now, because you should already have secured your next. In other words, you'll have adapted your operations and increased your resiliency. The other point worth highlighting before you go into funding sources is, as a firm, for example, we always, when we talk to clients, whether these are SMEs or big multinationals or global entities, we approach it from seven lenses, or rather 7 drivers. You will see one of those drivers is transactions here, and the other driver is finance. And obviously, the conversation for today will tease out aspects that relate to finance and aspects that relate to transactions. And just for your information, finance is really more the management of funding once it's in place, while transaction is more the aspects of either making acquisitions in the market or indeed even raising funding to fund your own operations. The two are related, but obviously separate. But the key point worth highlighting is this session does have an implication on both of those. So as I said, transactions, where you're talking about how do you raise funding, or how do you even deploy capital from your own business? How do you even sell your business if it comes to that, or how you get acquired? And while financing, the finance aspect of it is managing the capital you have internally. All right. Then the last thing to highlight is also that as part of those 7 drivers of growth, they map to the 3 phases that I emphasized before around now, next, and beyond. As I said, you ought to be in the beyond phase now, which means you need to be rethinking your future. You're figuring out how to sustain your growth, or indeed how to accelerate it if you're depending on where you are in this journey. The key point is you ought to be in this phase now, where you're managing your beyond. So even when you're raising funding, that really is the structure or the thinking that needs to underpin the conversations we'll have around funding, and we'll touch on some of those. Now, I'm going to now talk about the key considerations that particularly SMEs need to take into account when you're raising finance. And it's important to emphasize this, because at the end of the day, almost every entity or individual that you go to where you're trying to raise funding, it will really come down to more or less these 4 points here. There might be others, but the key ones will really boil down to these 4. So the first one will be on track record, which I will put a bit of meat around for your understanding. The second is on project, the third is cash flows, and the fourth one is security. Ideally, security, of course, comes with the type of funding you're raising, but we'll touch on that, and you'll see that I have kind of skewed the conversation around debt and less so equity, but we'll also talk a bit about that as well. So on track record, almost every investor, or indeed lender, or indeed even donor, so donors giving you grants, for example, that you don't have to pay back, or banks giving you loans, or external investors giving you equity investment. On track record, you will want to know who is the team, who are we investing in. In the market, typically we say you don't get money because you're a business, you get money because you're able to articulate your track record and particularly emphasize the people. People give money to people, essentially. Businesses invest in, or other investors invest in people. So that the team is important, and you should be able to articulate who the team is. Now, for some SMEs, that might be even one individual. For other SMEs, it might be a more substantive team. The key point is you need to be able to articulate who the team is, who they are, their experience, their track record, their credentials, and all that. That's very important. And always, we always say in every conversation you have where you're raising funding, start with your track record, and within track record, start with talking about people, the team. Don't even talk about your products. Don't talk about your platform. Don't talk about your market share. Start by talking about the team. What that does is you build a better connection. You come alive as a business. Now, a lot of SMEs we see in the market raising funding jump into their financial records and their products and all these things, and you just miss the point, because particularly for SMEs, the team is crucial. So you need to emphasize the team, whether that's you alone as the only operator, or indeed you and the staff or other partners that you're working with. The second thing there goes without saying, you need to emphasize your success, milestones, and achievements, whether that's in terms of the years you've been in business, or indeed how you've grown, or how many products you've been able to put out in the market, etc. And then your competitive advantage, where you have one. And typically competitive advantage will be saying, I am able to deliver something maybe at a lower cost compared to somebody else, or something like that. And then your market position. Your market position really is just showing where you sit in comparison, for example, to other businesses that are providing the same thing or serving the same client. Please go on mute. And then you need to also articulate your future plans. In other words, where do you see your business going? What are your plans for growing your business? And that could be either in terms of new products or services you intend to roll out. It could be new branches or outlets you want to roll out. It could be your plans to enter into new market segments, whatever your future plans are. Now, as I said, in order to be able to bring these things alive, you start by talking about the team, you emphasize what they are bringing to the table, and then on the back of that, you follow through with the other points that I've mentioned there. So that's the first key consideration for SMEs to raise funding. So even after this session, you ought to be thinking, how can you, for your own business, how can you articulate these things? How can you articulate your track record? On these 5 items here. The second thing is the project. Now, let's make the assumption that you're raising funding, you're raising debt funding, and by debt I mean typically it will be loans, but we'll touch on some of the nuances of that. But the point is, let's make an assumption that you're just raising debt. It goes without saying that you need to articulate what the new funding will be used for, and that typically boils down to, this is the money. Let's say you're raising $1 million. This is $1 million. This is what I'll use it for. And And on the back of that, you even show a lot more granular detail on that. But the key point is you need to highlight what the new funding will be used for. You yourself need to consider the optimal funding type that is required to achieve your goal. The example I'll give you is, let's say, for example, you're looking to raise maybe a loan, to get a loan, let's say 10 million shillings loan. You need to then say what are the sort of loan arrangements you need to have in place to be able to support your business. Can your business meet monthly repayments, or should you be negotiating, for example, for quarterly repayments? Should you be negotiating maybe for a grace period before you start servicing the loan? But the key point is you need, of course, to consider that. That bit about project is you need to align the funding that you're asking for to the requirement or the features of the project you have in mind. So I gave the two examples there. The first example being, if you're borrowing to, let's say, buy a piece of machinery, or to build a shop, as an example, you would not typically you would not be asking for a facility that is not also long dated, because if you do that, you will see that you will have cash flow problems. You will, in all likelihood, be foreclosed. You will probably have to shut down the business, or it might even be taken over, or things will be auctioned. So, and we find a lot of SMEs raising short-term money to invest in long-term assets, and it's a mismatch. Because, for example, as an example, if I'm borrowing money to build a factory, I'm using that as an example, to build a factory, I should be saying, give me facilities that are maybe 10 years long, and give me at least 1 year before I start repaying, because the factory will not start producing. So the point I'm trying to mention, to highlight here, is be very, very, very careful about how you source funding versus what you're investing the money you're borrowing for. If you start, for example, fund, and you've seen even big businesses in our very own market collapse because they're using, for example, overdrafts to fund long-term liabilities and things like that. The other example I've given there is if you're looking to raise money to fund your working capital facility. So a working capital example here would be, maybe you're looking to raise money to buy inventory. Then in that case, what typically you might want to do is to look for shorter term funding, or even to use an overdraft facility if you have one, or to do invoice discounting, which is a different type of funding. It's part of receivables and supply chain financing. We'll touch slightly on that. But the point I'm trying to make here is you need to look at the characteristics of what you want to use the money for versus the sort of funding that you need to raise, so that you don't have a mismatch. Otherwise, you will find either you're working, if you borrow from the bank, you're working for the bank and you feel deflated because you're always working to pay the back the loan, or you find that the business actually collapses because it can't actually service the facility that you've taken up, or it does service it, but it's leaving you very little to as a buffer to actually take home with you. So very important. And I will emphasize again, almost every SME we've looked at that has had serious cash flow problems, it's boiled down to a funding mismatch. You've borrowed wrongly, or you've structured the facility wrongly, and it's usually because you don't take time to explain the characteristics of the project to your funders and to insist on funding arrangements that make sense for you. Okay, so hopefully that point is made. The third point worth highlighting is cash flows. Cash is key. How you manage cash flow, whether you're a big business or small business, is absolutely key. It ties to the point I made just 2 minutes ago, where you need to really keep an eye on your cash flows versus your ability to service the money that you borrow. I'm using debt here for illustration. And then the second thing is you need to really look at your business history. How has the business performed? Maybe there is seasonal issues. Maybe there is stress around getting your money that's owed to you paid. Maybe there is other cash flow limitations that you have, where maybe you've mixed, particularly for SMEs, where you mix personal money versus company money. Now, the key point is you need to really interrogate your own business, understand it, so that you're able to know how really the business will perform, so that by the time you're going to ask for funding, whether from investors or banks, as an example, you are able to really you're able to navigate the period after you get the funding. The second thing, the third thing worth highlighting there is around the working capital investment requirement that I touched on earlier, essentially saying for the money that you take, for the money that you borrow, how quickly can you convert it in order to get money to pay for any debt you have? Now, if you're borrowing to, let's say, buy stock to manufacture something, and the cycle between buying the stock, manufacturing, selling, collecting, so that you're now paying, if it's too long versus when you're supposed to service the debt, you'll have a mismatch, because you'll get the money to buy the stock. By the time you turn the stock into finished goods and take them out to market, sell them, collect, the period might have probably gone to 60 days or maybe even 90 days. And yet you are supposed to service the loan every 30 days. So that mismatch can mess you up quite a lot. And a lot of SMEs have gotten into that trap, and it's almost impossible to come out of it, short of closing shop and getting auctioneers in. So again, understand the cycle of your business. How long does it take between ordering for goods, ordering for stock, manufacturing, selling, invoicing, collecting? That cycle, understand it properly. If you don't understand it properly, you will think initially you'll be able to service all these loans that you collect, and then all of a sudden you're caught up in a cycle that's impossible to come out of. I think the other points are self-explanatory, so I will not emphasize on them, but the key point is your understanding of your own business, and this could also be a service business or not. Please go on mute. It could be a service business or otherwise, but the key point is the cycle of your cash flows and your collections need to be absolutely on point, and you need to allow for a buffer in order to be able to meet your obligations. The last thing that I think is familiar to everybody is security. So you need to have in mind the security. For instances where you're borrowing and you have to have collateral or security to secure the facility, then of course you need to understand what security you are really going to make available to the lender in this scenario, and also more importantly, whether it is suitable to backstop any potential issues with payments. You may already know that in our market we have all types of securities, but also aspects of enhancement around it, whether that's backstopped by personal guarantees, whether that's backstopped by floating debentures and things like that. But the point is you need to also think before you even go to your lenders or other investors, understanding the sort of security that you need to put in place to backstop the lending that you pick up. The security aspect, I think, is from a collateral perspective for the Kenyan market or indeed the East African market, that's fairly developed. It will either be land or other assets, so I will not dwell on that. What I can tell you is sometimes it's not even worth pursuing a securitized product, but we touch on examples where you don't need to do that. So the next section that is worth discussing is the various options and the pros and cons around them. I thought I should do that before I start talking about some of the sources, because I think I find that a lot of businesses rush into tapping whatever funding is available out there, and then usually they don't have a good sense of the upside and downside of these sources of these funding options that they go for. As a result, you find the issue is not accessing funding, the issue is actually even being able to sustain repayments, and you then get into, as I said, a spiral that can ideally mess up your business. So I will highlight to you some of the options that are available, but even more important, I'll also look at some of the pros and cons for each of them. Some of the terms here will be familiar to some of you, others not. Don't worry about essentially the naming of the options. It's the characteristic that is worth understanding. So I will start with the top one here, mezzanine funding. So mezzanine funding, typically it's a hybrid of both debt and equity funding. So actually what I'll do is, let me talk about debt and equity, then I'll come back to mezzanine. So debt, we know, I think all of us know, essentially these are loans. Okay, and those loans can come from, for SME purposes, they can come from individuals, they can come from institutional investors, they can even come from existing shareholders of the SME itself. The key point is, typically debt will require collateral, and the upside of using debt instead of some of the other option that I will mention is that you maintain control of the business. You're the owner of the business, is still yours. Okay, and typically most debt would not have any voting rights and stuff like that. So the point is, you have control over your business, and the true analysis only shows that by and large debt is always cheaper than equity. In the scheme of things, debt will always be cheaper. The reason we say that is if you're able to get a debt facility that enables you to grow the business, and it's growing in leaps and bounds, and you're making profit, you only pay for the debt and you keep your profit. So if it was not debt and it was equity, and we'll touch on equity, then obviously you'll be sharing part of that profit. The key point to take note there is control is still maintained. The downside, of course, is that you're locked into payment, and this can be a death grip, and it has happened in a lot of other SMEs and non-SMEs. So and then of course you have to adhere to the covenants that are part and parcel of the loan agreements or the debt agreements. So the cons there is that the downside is that you're stuck with the payment schedule, and to change the payment schedule, you'd have to negotiate with the bank afresh. And most of the times they will charge you either a lot of fees to renegotiate or refuse, actually. As I said, you also have to stick to what you agree with the lenders. So that's debt. Then equity will come in primarily two types. And I'm keeping this absolutely simple. Obviously, it can get even more complicated than this. In the world of corporate finance and mergers and acquisitions, it can get quite complicated. But to keep it simple, you either have a minority stake or a majority stake from an equity perspective. In the minority stake, essentially somebody comes in and buys a stake in your business, typically to be less than 50%. And they are co-owners of the business. Okay, now if it's a minority stake, obviously you as the owner, assuming that it's one single owner in this case, they still maintains control of the business. I'm holding all factors constant. You still maintain control of the business. So if you're owning 100% of the business and you're looking for, let's say, 50 million shillings, I can't give you 50 million shillings. We value the business, and I say for 50 million shillings, I own 20% of 25%, 30% of the business, as long as it's less than 50%. So I am a minority shareholder. You maintain control because you have more than the majority, more than 51%, and obviously any upside to any profits we make, we share according to the shareholder agreements that we have. The beauty about raising that sort of money is that it also comes with other experience that I, as the new shareholder, will bring. I might bring new customers, a new way of thinking, new skills that you didn't have. or indeed even access to other opportunities that you wouldn't have had I not been a shareholder. Because we are growing, we own the business together, we're growing it together. A lot of SMEs have difficulties aligning with this, but I think everyone is on a journey as it is. The downside to a minority stake is that typically, if you are later trying to sell the business, it can affect valuation, and also sometimes new shareholders might not share the same vision you have, in which case you start having disagreement, court cases, and potentially fallout, or indeed sale of the business, or destruction of value, essentially. So there's a downside to that, of course, because it's now not just your business. The other option for equity, and again, as I said, I'm keeping it simple, is a majority stake. In other words, you own the business. I can put in, let's say, 50 million shillings, and I own more than 50% of it. I own, let's say, 60% of the business. Now, the upside to that is you will have driven a very good valuation conversation. In other words, for me to actually bring in a certain amount of money to and own the majority of the business, typically we find in the market the valuation of the business itself is usually quite high up. So you, as the owner of the business, the original owner of the business, will enjoy that bit. And similar to the minority stake, the new owner, the new majority owner, will bring, of course, experience, capital, and other value. Now, obviously, the downside is that you lose control of the business, so you're no longer the key shareholder. You're not necessarily having veto rights, so I can overrule any decision you make, depending on how the shareholder agreement and voting rights are, and of course I can even change the direction of the business and move it in a different way, or even sell it without necessarily consulting you, although of course there are rules around how that ought to be managed. But the point is, you can raise funding, sell the business to a majority holder, lose control, but still enjoy the upside. And that's also happening in the market. Which brings me now back to the first option on mezzanine funding. So mezzanine funding is now a hybrid of debt and equity. You already understand the debt aspect, you understand equity, so somebody is owning a part of your business, debt, loans, essentially. Now there's a hybrid of debt and equity. What really happens, to keep it simple, is the person that is bringing in mezzanine debt. So let's say I'm the company that is lending you money, but as a mezzanine loan or a mezzanine debt. What will happen is, it's a loan, but it gives you certain rights as if I was a shareholder. Okay, now part of those rights typically would, for example, be that I can vote, I can stop you from making certain hiring decisions, as an example. I can even convert my debt into equity. And so there are different ways to chop and change the terms for mezzanine debt, but typically it has both debt and equity characteristics. The pros is that you don't get diluted. So you're the shareholder, unless I convert, you're still the shareholder and you own the business. So you're not, dilution here means your control of the business is not reduced. It's also more manageable than pure debt, than pure loans. Mezzanine debt is more manageable than pure debt because, for example, a mezzanine investor sees the business almost like a shareholder does. So if you need, for example, if things are tight and you need, for example, to renegotiate the debt terms because the business really needs some breathing space, the mezzanine debt lender is more likely to listen to you compared to a pure debt, let's say a bank, as an example. Now, there's a con to that. It's more expensive. And of course, it's high risk because depending on how you're looking at it, I can convert my debt into equity and own the business, even if you did want me to, depending on how we've worded the contract. So I'm highlighting this for you as SMEs because a lot of SMEs think funding as debt, and most of them are in the market running around looking for loans. They've not considered selling a stake in the business. They've not considered not doing pure debt and not doing pure equity, looking for mezzanine funding, or indeed, they have not even thought what the pros and cons are for funding options. there's a lot more material around these topics, but if there is anything that is what I'm emphasizing here is take your time to understand your business, take your time to consider which options you go for, and then on the basis of that, make the right decision. Okay, debt is not the only answer. Let's put it that way. So that's right. And I wanted to also just mention to you examples of investor groups that actually have interest in the two areas we've just covered now. And obviously, there are SMEs here that will more or less be of interest to certain large investors. But there will also be SMEs here that are probably too small to be of interest to some of these investors. But nevertheless, it's worth knowing because they are all on a journey, and you too will get there as well. So the key investor group that, particularly in East Africa, that is really interested in majority stakes in SMEs will be the strategic investors. So I will highlight what the strategic investor is in a moment, and then financial investors. Financial investors is the easiest one to explain. So financial investors typically will be investors that are just looking to come in, write a check, so to speak, agree on some terms, put in money, and sit back and watch you run the business. And hopefully they will exit at several multiples of the money they put in, whether we're talking debt or equity. The typical financial investors you can think of will be typical private equity firms, banks, some of the DFIs, developing financial institutions. Those are financial investors, and typically they are out to make money, pure and simple. And that's that. Okay. Typically, they will want to have, depending on the business, they will want to have a majority stake, simply because it makes more sense for them. But we've also seen financial investors looking for minority stakes. So there's a lot of private equity firms in this market that typically usually will only go for a minority stake, and the minority stake usually is anything below 25%. Of your business. And then you have strategic investors. These typically are international players that are looking to enter the market. So the example there would be, let's say I'm a British company, I manufacture pens in UK, and I'm interested in entering the East African market. And now typically I will have three options. Either I come and look for an opportunity to buy an existing company that is already manufacturing pens. I invest in it. I probably go for a majority stake, and then I'm now in Kenya and I have a business of an existing business that is selling pens. The second option would be I come and set up shop from the ground up. So I come, set up a factory to manufacture pen straight up. And of course, the other option typically would be I don't buy an existing business, I don't set up shop, but instead I look for a distributor in Kenya and I sell them my pens from UK to sell here, and so I'm already getting a market share in Kenya. With time I can convert that to an actual investment etc. The point is that for SMEs, a lot of the strategic investors we see are investors that are looking for good SMEs to invest in as a way to access the African market, East Africa, in this case Kenya in particular, and then use that and bide their time to grow, to put more money and expertise to grow that SME to the point where it's a big enough SME or business where they can even now offer to buy 100% of it. Now, strategic investors invest very differently from financial investors. That's important to know, even from whether we're talking debt or equity or a hybrid of it. The reason strategic investors invest particularly different from financial investors is they are not there to exit typically in 5-7 years. Most financial investors will want to exit 5-7 years, if not less. Strategic investors are in it for a long term. They come and they want to have a seat on the board. They want to bring their own expertise. They want to even help you formulate the strategy for your business. So they are not in it to just make a quick buck and leave. Okay, so you won't see them, for example, coming and loading extra debt on your business so that they can make some quick return and exit and leave you. So that's a different thing, but they are not many. So you need to be an SME that is in a certain sector or a certain shall we say makeup to be able to attract certain investors. But as I said, the two are very separate. If you have an intention to attract certain investors, you need to structure your business fairly formal and to be set up in a very strategic way so that you're able to attract these sort of investors. We can touch a lot more on that in the Q&A. Moving very quickly. Just some key points to consider in this fundraising process. Whether it's debt, as I said, whether it's debt or equity you're looking for or a hybrid of it, please prepare very well. It's unbelievable how many opportunities are lost by SMEs because they are not properly prepared. The issue is not funding. There is tons and tons and tons of funding available. Tons of it. The problem is you have SMEs that are not just SMEs, even big corporates that come in the market looking for funding with poorly put together documents, poorly put together corporate financials, poorly put together supply agreements and things like that. So prepare vigorously. I mean, it's important that that's done and done properly. A lot of SMEs that have raised money, particularly foreign-owned ones, and you're aware of a lot of them, they've raised it because they actually prepare rigorously. It's not because they are any special, but they've put in the work to actually put things together properly. Every time I travel, across Africa, this is the one thing that is a bit of a pain and disappointing, that people have seriously good business, seriously good opportunity, huge interest from financiers, but they don't prepare. And therefore you find, particularly for African-owned businesses, 10 that go into the market looking for funding, only one gets the funding. While for some of the others, you find probably 5 or 6 of them always get funding out of 10. So you can see the mismatch. And most of the time, it's because we've not prepared properly. The second thing is to develop a compelling story, particularly for where you're looking for equity investors. You need to really get it in your mind why you're looking for funding, who you're actually expecting to fund you, and why they should fund you. In order to do that, you need to be able to articulate the value of your business, the plans you have, the journey you've traveled, and where you need help, why you need this equity to take you to the next level, and what you do with the funding that you. Again, a compelling story. A lot of our other guys who are in the market actually do this very, very well indeed. They package their story, even something that is not really that big. They package it and it comes through as something very polished, refined, and very articulate. Now, if you don't do that, in all likelihood, particularly if you're looking for equity funding, you won't get it. You won't get it, or you will get it, but at very low valuations. So you find you're selling your business for a sum. The last thing is, of course, to limit surprises, so have consistent and predictable data, particularly financial data. And as I said, really be prepared. It doesn't matter whether you're a small entity or a big entity. In fact, it doesn't matter when you're looking for grant funding, so free money, as it were, versus loans or equity. It's the same process. Prepare rigorously, develop a compelling story, limit surprises. And by and large, if you do this, you will get funding. That I can guarantee. But again, as I say, we go through this motion so many times, and it's still disappointing how much good advice like this is not taken, when in fact the ones who take it actually find the results. So I will now go on to the funding sources, and I will cover first high level, and then I'll give some indicative examples. As an SME, or indeed a startup or a sole proprietor, it doesn't matter. Typically, you will find most businesses will be tapping funding in any of these lines here. I will cover bootstrapping, a bit of angel crowd and receivables. I will not bother talking about loans from banks because I think you all know about loans from banks. So I don't think that will be the best use of our time. So bootstrapping, typically that will be what every one of you have probably already done, including me, which is you use your own personal finances to fund your business. It's typically where everyone starts. It's probably where a lot of you already still are, and that's fine. Now, it's important though to highlight something. When you bootstrap, in other words, when you're using your own money and all these things, do not forget to keep records of it. A lot of businesses have gotten subsequent funding because the little money of their own that they put in the business, they recorded it properly, they supported it with documentation, they had accounts for it. It's not your money, it's the business money. You've lent the money, you've used your money to fund a business. Now, remember, your business and you are two separate things. And that has been the basis for attracting new funding and also for articulating your story. Where we fail, and a lot of SMEs, particularly in Africa, fail, is there's no formality around how you bootstrap. There are no records. You probably even borrow from your family and you disagree with them and things like that. So putting structure around even bootstrapping is absolutely key. It's the reason you will be able to walk to KCB, Equity, NCB, or wherever else, or MasterCard, and they will give you more money because you have a record of the money that you used to buy your first motorcycle, that you used to do this, and kept some records, etc. So that you see people who have built very big businesses, and they start by telling you, I had 500 shillings from selling my chicken, then I bought a cow, and the reason that is that story resonates, particularly when you're raising funding from institutional investors, is that story is actually the business. It's the business. So that's what I was saying. It's really important. Even bootstrapping, put your records in order. Keep tabs of where the money is going, and you will see actually that will enable you build discipline that will take you from leaps to bounds on even more larger amounts of money that you raise for your own business. The second option is angel investors. The angel market in Africa is not very well developed, to be honest. In other markets, there's even structure and formality around angel investing, including even tax breaks and other government support. Nevertheless, for your information, angel investors, typically this will be successful entrepreneurs or indeed corporates that put money together, and they are willing to invest in SMEs and other startups and early growth companies in exchange typically for equity. And now you know what equity is. And it will also include friends and families, but typically it will be strangers. So it will be ideally, shall I call them, ideally it will be high net worth individuals or indeed philanthropists who are out to look for businesses to invest in. Now they will invest because you package yourself properly, as I said before. But just so you know right now, and after this you can go Google all these other guys here. There are actually some established angels network that you can tap to, and they are literally looking for opportunities even as we speak. There's the African Business Angels Network. The other one I think what they're highlighting is the Angel Investment Network, which also, I think after this call I'll share some links with Terry, then you can have them. But the point is they are actually existing Angels Network that specifically look for SMEs like yours to invest in. And as I said, the only way to get their attention is to package your story properly and be very well prepared. But they are there, many of them. Now, the reason I'm not necessarily highlighting the individual ones rather than the networks is because a lot of them we work with, I can't be seen to marketing them. But the point is they are actual angel investors, particularly in Nairobi now, it started to develop a bit more. I've given you examples there and this more. When you go to, for example, to the Angel Investment Network site or the Africa Business Angels Network site, you'll actually see the list of them. You see the sort of geographies they are interested in and the sectors they are interested in. So you can then start packaging yourself accordingly. The other one that is very highly notable would be the private equity and venture capital firms. As I said, these are typically big entities that have raised substantial amounts of capital to invest in businesses, whether those are SMEs or otherwise, and we are talking about multiples of funds. So we're talking about funds that have hundreds of millions of dollars available for investment, and you will find it will vary. But for example, for venture capital firms in Kenya, they will usually invest around to $50,000 to maybe $1 million. It can even go to, let's say, $100,000. While private equity firms typically will be looking for opportunities from, if it goes low, it will be $5 million. But sweet spot usually 10, 15, $12 million there. Now, I'm not necessarily saying all of you are in that category, but the point is private equity firms and venture capital funds will be looking for opportunities amongst yourself. The key thing will still be, you need to be prepared, you need to have your documents properly, you need to know what you're negotiating for, and of course you need to be able to articulate that in a proper way. For SMEs, it's probably easier to get funding from VCs, from venture capital firms, versus PE firms. If you're an SME that is doing fairly well with an history, then going straight to PE firms it would be recommended. Most of the PE firms in our market will do both debt and equity. The equity will typically be structured as convertible debt. So in other words, it's debt that can be converted into equity in time, but there will be there's a whole range of potential funding options. Okay, and the best way for East Africa, the best way for you to identify PE firms and indeed venture capital firms, you can go to the eavca.org, the East Africa Private Equity and Venture Capital Association, which has the list of all the PE firms and the members there, what they invest in, what they have already invested in, how much they invested in those entities. Sometimes it's even disclosed, and of course also what sectors are of interest. So you already know who's looking to lend or invest in a business like yours. Similarly, in the larger continent, we have the Africa PE and VC Association, so EAVCA, and we also have another site as worth looking at, which is the Venture Capital for Africa, vc4a.com. Again, these slides will be shared with you. The reason, again, as I said, I've not listed the private equity firms themselves and the VC firms themselves, is you can find them in this list here, and I don't want to highlight a particular one, so that I'm not seen as if I'm endorsing any particular one. It's for you to do the homework, but you will find all of them here. Okay, and I would say for East Africa purposes, prioritize this one, because the Africa private equity one has entities that invest all over Africa, and some of them are foreign entities that really are looking for very big opportunities. People looking to invest like $100 million to $50 million. So I think for SME purposes, you need to calibrate to the reality of your business, so that you don't waste time approaching entities that probably may discourage you. Okay, so that's the other category. That's one highlighting. It's important for you to understand how VC firms and private equity firms invest. It's very different from how a bank invests. For example, private equity funds really get into the nitty-gritty of your business. They do due diligence to understand your business before they put money in it. They are sticklers for contracts. So you need to understand, if you sign a paper, they will insist that you obey the covenants in those agreements. So again, don't rush. Take time to understand these things, but trust me, once you get your head around it, you will be surprised. You'll be the one telling everyone else in the market, just the issue is not funding, it's packaging yourself. And you will hopefully then be able to spread the word to other people as well. And I should mention that a lot of our indigenous owned SMEs found it a lot more tougher to get funding from these entities because of that issue of not being prepared and not having proper structures in place, compared to some of the other foreign owned SMEs that are very quick to put their house in order, have proper preparation, put their story in order, and actually be able to articulate it to these PEs, and they get money just like that. And you will have seen what in the papers, the sort of SMEs that are getting money, so funding rather. So please prepare properly so that then you're able to get funding. The funding is there, as I said. The issue is not funding, it's packaging. The other one that's fairly newish in our market but fairly developed in, for example, in the Western world, is crowdfunding. It's starting off quite well in Africa as well, and in Kenya in particular. I've given examples of crowdfunding platforms, but the key point about crowdfunding is that you can raise capital by getting small contributions from platforms, and those contributions really are money investable that's being invested by individuals either within Africa or somewhere else. The diaspora, for example, the African diaspora, for example, invest quite a lot through crowdfunding platforms. So they are more, shall I say, sympathetic to African SMEs. So again, do your homework around crowdfunding platforms. I've given you examples of them, and I've also given you an association directory there that you can have a look at. Do your homework. The opportunities to actually get funding, particularly for SMEs that are doing, for example, participating in the agricultural value chains, that are trying to export from Africa, that are trying to service, for example, the tech space. You will find a lot of appetite for crowdfunding investors to put money into your business, including people who are in the renewable energy space, because that has a lot of social impact type angle to it. So again, please do your homework around crowdfunding, and you will see. Again, the one thing I think to mention again, to emphasize, is package yourself properly, and of course, once you get funding, apply it diligently to what you've raised it for, because if you do that, then you get an opportunity to come back and tap more funding, and you keep growing like that. Don't take the money and not do it for what you requested it for. This is one that is very exciting for me personally. Very exciting. It's a huge opportunity, particularly for SMEs. It's still a developing market in East Africa, or indeed the whole of Sub-Sahara, bar maybe South Africa and Egypt. So supply chain financing, including receivables financing. Typically, this is money that you can. This is funding that you can get on the back of either purchase orders that you have, or invoices that you have, or indeed even your projected payables. So the beauty about this sort of financing is that it's not a loan. Specifically sticking to supply chain financing, it's not a loan. So you're not indebted as you put it. It also does not require you to be tied to a single bank. So there are platforms out there where you get funding and it's not specific to any particular bank. So you're not tied to a single bank. It's not factoring. Those of you who are aware of factoring, supply chain financing is not that. In a sense, it means that for every invoice, you get 100% of it, plus they take off a small transaction fee. And then the truth of the matter is, while a lot of the supply chain solutions that are available in Kenya, in East Africa generally, but in Kenya in particular, are primarily targeted to large companies, they also fit SMEs. So it's just a question of having that knowledge to ask for supply chain financing when you're having conversations, for example, with your bankers. But it also does not require a bank. There are alternative funding solutions, funding entities, alternative lenders that can give you supply chain financing, including receivables financing. Now, I understand the topic might be a bit new to some of you, but my advice to you would be this. When you go as an SME, when you go to the bank, instead of going to the bank and saying, can you give me a loan, tell them, do you provide supply chain financing, or do you provide invoice factoring, or do you provide receivables financing? If it's a bank that is worth its salt, they will understand what you're asking for, and they will direct you to, typically it will be called the trade finance team, that can then talk to you about giving you money on the back of your trading activity rather than a loan. In most cases, 99.99% of the time, they won't ask for security. Now, the catch is this: you really do need to have proper records in place, because the way they evaluate this is they look at the records, how you've been trading, how you've been collecting from whoever owes you money from invoices, where you order your goods from, what you do with the inventory, all that stuff. See, the only way they can give you money is because that data is self-sufficient and sensible. In which case, then they don't ask for give me a title deed, give me other security. The key point is this is an opportunity for you to start thinking on how you can improve either your record keeping and your other knowledge, so that then you can start. Does not require you to jump and get title deeds and all that, because not all SMEs have those sort of securities. In fact, it may well be that it can drive your business even further without necessarily having a huge capital outlay on your side. So again, when you go to your banks next time, in case you haven't, ask them about receivables financing, supply chain financing, what they say. Most of the big banks, KCB, Equity, NCB, Corp, all those guys will usually have this already anyway. But as I said, just to emphasize, the catch, you need to have your documentation and all that stuff in order. Now, I will zip very quickly through this because there's a lot of other information that we can share online. But there are some sources that I wanted to just highlight for you guys to be aware of. So that if you're aware of them, then good enough. If you're not, you need to be aware of them and start thinking of how to tap this funding. USAID has started a program. It's called the Kenya Investment Mechanism. It's a $400 million facility that is meant to help. That is meant to essentially be to support SMEs. Okay. Now, the way the funds are being put out into the market is through implementing partners. I've given you the link there. Some of the implementing partners are people like Palladium Group, Tesserian Capital, etc. But the point is, go to this link. That $400 million is, even if you were to put your affairs in order and go and ask for $500,000 or $1 million, and it came through, it's very, very competitive priced funding. So again, have a look at that. It's a big platform that is intended to actually become bigger once this is successful. Then, of course, one of our key sponsor here, Mastercard Foundation, has provided funding to KEPSA, the Kenya Private Sector Alliance, the Women Work Network, the Chamber of Commerce, and others there. That funding is meant to support SMEs. The link I've given you there, you will see the sort of activities they are planning to support, or are already supporting rather, and particularly regarding impact of COVID-19 on SMEs. So that tells you that you also need not only to understand how they are funding, but you also need to understand, to be able to articulate how COVID-19 has impacted your business, so that then it's easier for you to get the funding that has been put forward by Mastercard. And again, we are talking about hundreds of millions in that case. Then there is another one worth highlighting, is the $14 million facility that is managed by the BPI SME Fund. It's supported by, among others, the European Investment Bank, and it's meant to provide loans, equity, and quasi-equity finance to SMEs. You now already know what quasi-equity means. The example there is the mezzanine funding that I mentioned to you before. Again, there is a link there for you. Then there is Visa Foundation. I've rolled out about $210 million. This is not just for East Africa, this is for Africa, but again, I've given you the link there. You need to be able to articulate your story to be able to tap this funding, and it will really come down to what your plans are, or your history, your plans for growing your business, and the use of funds that you're requesting. There is the Africa Guarantee Fund. There's a link there. The Africa Guarantee Fund is meant to enable you as an SME to get funding from banks at better pricing. In other words, if today you walk to, as an example, to let's say NCBA as an SME, and they look at you and say, you're asking for 20 million shillings, we can only lend you if 1, 2, 3 things are in place, or we can lend you, but we think you're risky. Then the Africa Guarantee Fund steps in to de-risk that on behalf of NCBA, so that NCBA can give you the 20 million you're looking for. Again, get an understanding of which banks have that facility behind them. I've given you the link there as well. And again, these are multiples of millions that we're talking about. So if you are looking for 500, a million, that sort of thing, then this qualifies for that. You are aware, if you are in the tourism and hospitality space, you are aware that the government has recently set up the tourism stimulus fund. I've given you the link there. The applications are already being processed. So again, depending on the sector you're in, you'll be well advised to have a look at that. The call for applications came out the other day. In fact, the disbursements have already started happening. So that's about $56 million, but that's specifically only for Kenya. There's the Stawisha SME Machinery Fund that's being set up by several entities. I've given you the link there. The key thing about the Stawisha one is you'll be well placed, for example, to work closely with people like the Invest in Africa in order to unlock some of that funding. And Terry in the beginning mentioned that she can facilitate some of the investor readiness aspects, so that would be useful. Then there are others I've listed here. I will not go into details of them in the interest of time, but the links are here. Now, before we go to Q&A, conscious of time, I think there's just one thing I want to re-emphasize again. The issue is not lack of funding, because other than these things I've listed, to this crowdfunding association platform, you have hundreds of sources of funding listed there, available, just waiting for somebody to tap them. If you go to the PE and the VC listing, you have hundreds of firms willing to invest millions of dollars into SMEs. So the issue again is not availability of funding. What is lacking, and bear with me, emphasize it again for the sake of hopefully helping all of us actually on the journey we are in. It's these 3 steps that I've highlighted here. You need to prepare rigorously. You need to develop a compelling story around the funding you need, even to yourself anyway, because it will enable you to understand your business even better. And then you need to really have predictable and consistent financial information to support your fundraising process. If you take anything away from this session, it's these 3, so that you give yourself a challenge. Can you step up and sort your story so that when you and another SME walk in front of a potential investor or lender, it's rather obvious who they should go with? That's for me is the takeaway for the masterclass, rather than just giving you all these lists of potential investment funding sources, because you will go to all of these and they will reject you if in fact you don't do the 3 things that I've mentioned to you earlier. And as I said, and it's a bit discouraging sometimes, a lot of foreign-owned SMEs do this 100% better than a lot of our own businesses, and which is why you see a sort of mismatch between businesses that are getting funded versus the ones that we are hoping get funded. So please, you do the homework on your side, because the funding is there, and then I think we'll have a lot more success going forward. I'll stop there in the interest of time and then pass back to Terry. Thank you.
That was a fantastic, a really timely, very relevant conversation today for SMEs. What Frank has highlighted in the end as a takeaway is the most critical. Prepare rigorously. Are you having the support that you need to be able to prepare rigorously? We have talked about the Invest in Africa Investor Readiness Program. It's basically meant to prepare you to access the financing that you would need, and you will also be supported by BDS providers, all the way accompanied by a negotiator to be able to access much of this financing. It is not at a cost to SMEs because it has been supported by Mastercard Foundation. We really would like you to take advantage of these opportunities which are out there. Compelling equity story, you've had it, limit surprises. Already by coming to this session, we can say you've taken the first step in sort of getting ready and stopping to grope in the dark when it comes to what funding sources are available. Orac Branding would like to pose a question.
Thank you, Terry. And thank you, Frank, for that resourceful and timely presentation. So my question is, my name is Monene Gedera, team leader Orac Branding. We've been in business now for 3 years, but now we are looking to get funding for some of the visions we have. And like the speaker was really emphasizing on packaging ourselves and really preparing. So my question is, for the last 3 years, we haven't really prepared well in terms of putting structure in some of the things you said, like the cash for bootstrapping, etc. So where do we start from as a business and as a business leader now going forward? And is there a way I can track back some of the structures, maybe our bank accounts, our M-Pesa? Yes.
Yeah, sure. Thanks, Munene, and of course, congratulations for what you've achieved thus far. You're not alone in that situation, to be honest, because we all learn along the way. I think the short answer to your question, Munene, is threefold. The first one is even in accounting, we have something called reconstructing books of accounts. So typically what happens is you can get an accountant somewhere out there to enable you reconstruct your books of accounts. That's important, because if you don't do that, even investors might be fearful that you might, for example, have unpaid dues, for example, tax dues in the last 3 years where you didn't have formal structures. So that's the one thing I would say. So putting together, reconstructing your books of accounts, and it's fair. It's for an accountant, it will be fairly straightforward. They will sit with you, understand what you've been doing in the last 3 years. If you have a bank statement, they will look at the bank statements to help reconstruct the numbers. If you have been using your M-Pesa as an example, they do all that. So there will be a way to reconstruct your books and put them in place. What is important is, as part of your story to investors, then you need to be saying that, look, for the first 3 years, we were informal. Our records were not necessarily fully there. This is what we've done since then. We've reconstructed. This is the cut-off point. After that, we have formal structures in place. Investors who are looking to invest in SMEs will then understand that. That's part of your compelling story, actually. So reconstruct that, your accounts. The second thing to mention is you of course have the other option. I would not recommending it, but just be aware that we have instances where guys have set up afresh. In other words, you set up Oracle Branding 2 Limited, you put the structures, and then you start from there. So you have two options. I would recommend the first one, where you reconstruct your accounts. That's, you pay a small fee to any of those accountants out there. They will help you put those things in place, and then you can formalize going forward. But congratulations either way on your journey so far. Hopefully that's helpful.
Thank you very much, Frank. Just one more question from Gladys, and we'll wrap it there. She asks, how can startups get funding? Because her business has struggled. She's starting over now. She does have collateral in the form of property. And where will she begin to access the funding as a startup?
Right. Okay. So I'll keep it simple. The issue, as I said, is not funding. Funding is available. It's a work backwards. The first thing is, what do you need funding for? I am assuming it's growth, because you're a startup. That's number one. And then number two is, you then say, what sort of funding are you looking for? Is it debt? Is it equity in the mix? And then number three is, how do you then package yourself for all the various available funding sources? For startups, Typically, if you want to use external funding, you will have go for venture capital firms, not private equity firms. Most private equity firms will not invest in very early stage companies. So venture capital firms, again, they are listed in the links I shared, and then angel investors. Now, of course, if you, depending on what is it you're doing as a startup, you can also go for grant funding. So a lot of the grant funding will come from foundations. So the notable ones is for example, the ones who are sponsoring us now, Mastercard Foundation. If you package depending on what you're doing, they can give you funding. Equity Group Foundation, Safaricom, Sparkworks, there are many. They are all in that list as I shared. But the key thing is, what are you looking for funding for? What sort of funding are you looking for? And then obviously, how do you package that for funding purposes? You mentioned, just very quickly, you mentioned you have collateral. You see what the mistake you're already doing is you're already offering debt. You're already offering collateral before you even package your story. So don't worry whether you have collateral or not. First, package your story properly. Then you might even find that collateral is not required. Don't worry whether you have collateral. It's a good thing, but it's probably not even the appropriate thing to go for, depending on what you're doing. But the point is, first confirm what you want funding for. The rest will fall into place.
Thank you very much, Frank. A few comments. One person says, this presentation has been very insightful. That is from Ken. Nick says that the presentation was first class. And finally, just one more comment from Arnold, who says it was a very insightful presentation. So that brings me to expressing our deep gratitude and thanks to Frank Mweti. He facilitates masterclasses with Invest in Africa and Mastercard Foundation at least 2 times every month. Please be on the lookout on very strategic themes, as well as the more the themes that will help you to continue with your business at the moment. So feel free to connect with him also directly. Frank is with EY, and the EY also has SME solutions to help you with much of the discussions that we have been undertaking here. So we have put up his email for anyone to connect directly. And I would like to just close Mweti with those few remarks of thanks by giving a final call to action. Once you have had this masterclass, what will it do for you and your business? We have already expressed that there's an access to finance investor readiness program that we are extending to SMEs free of charge. Please email to pauline.mushai@investinafrica.com if you would like to be considered for this session. We also have business coaching. If you already have plans or you would like to be supported by a coach to come up with your plans and implement them, reach out to us. We'll be able to support you with that as well. From one of our partners, Ongoza, we do have a 9-month accelerator program as well, which can help you to access low-cost debt financing. It also involves an introductory course on business fundamentals. So just business skills to help you, carry forward with your business. They undertake business diagnostics. So if you want to find out where you are, you want to maybe do this as part of writing your compelling story for equity, Goza does that. They can help you in prioritizing goals and just coming up with a growth plan and review this every quarter. So basically somebody to work with you for 9 whole months as you work on your business towards recovery and resilience. You will also access one-on-one individualized consulting from their in-house consultants, and there's several workshops on different portfolio needs held every month. We are holding a number of masterclasses in collaboration with Ongoza. So we're just saying that the support is in abundance. Please reach out to us to access this. I'll put up our contacts for Invest in Africa before we call it a day. You can reach us via social media. We are also located in Nairobi Bush House, which is on Cabernet Road off Ngong Road. You're welcome to connect with us on all our social medias. Write to us. We want to know how to support you. We want to together with you build strong businesses and enterprises which will create jobs for Kenyans and bring about prosperity. for our nation. So thank you very much for joining us today. The masterclass has ended. Look forward to seeing you for our next masterclass to be held next week.